Hello everyone. Today we are going to walk through the use cases and associated workflows of a fixed income performance analyst on Aladdin. We'll start with an overview of the business functions of a performance analyst, then jump into some of the key concepts and methodologies they'll need to understand and how those are applied on Aladdin, as well as cover some key workflows that these users would perform on Aladdin. A performance analyst is most often responsible for generating analysis and reporting on a portfolio's historical performance, as well as attribution of that performance by various methodologies appropriate for the type of portfolios being analyzed. They may also then disseminate that information more broadly across portfolio management, research, strategy, and investment risk teams to ensure that all business functions involved in the portfolio management process understand historical performance drivers. To perform their analysis and day-to-day workflows, performance analysts primarily leverage Explore, a one-stop shop for reporting and portfolio analysis. The first key concept to understand for a performance analyst is how Aladdin handles the calculation of performance. Returns on Aladdin are calculated at the security level and aggregated to the sector, portfolio, and enterprise levels daily, then linked into multi-period returns via the standard compounding effect. Once calculated, performance can be displayed as one of three types of returns: P&L, or dollar-based returns; return, as in the P&L of the position versus the market value of the underlying position; or contribution, which is the P&L of the position relative to the market value of the total portfolio. Returns at the security level are first calculated based on accounting factors such as price, income, paydown, FX, and so on. Looking at the first view that we've created here within Explore, we can see the decomposition of performance into those types of factors, starting with our total P&L and then going into specific factors. First, we have price P&L, which measures the performance attributable to changes in valuation of each security in the portfolio. Next, we have income P&L, which is driven by either daily accruals, interest payments, or any sort of miscellaneous cash entries or corporate actions booked on the securities. Paydown P&L is another key component, which is based on receipt of principal based on changes in factor for instruments like structured products or other factorable bonds. FX P&L is due to changes in spot rate for non-base currency instruments in the portfolio. Finally, trade P&L is attributable to the difference between the intraday trade price and the end price of an instrument on the trade date. Summed together, these P&Ls equal the total P&L of each underlying security. You'll also see that within Aladdin, we have the ability to go from the total portfolio P&L down through any sort of breakdown or sector scheme, getting us to the underlying P&L of individual instruments. Each of the breakdowns and sector schemes leveraged here are highly configurable, so they can be designed specifically to meet the needs of the end user. So the first broad workflow that a performance analyst might perform on Aladdin is the evaluation and assessment of performance. Once we've understood how our performance is calculated, as we've just done, we can then decompose it and seek to understand key drivers. Aladdin provides users the ability to evaluate performance based on a risk-based decomposition, inclusive of elements such as yield curve positioning, carry and FX exposure, fused with a decision-based attribution via a Brinson 2 or 3 factor attribution analysis. This provides users a framework to fully evaluate the performance impact of the set of investment decisions made on a portfolio. Coming down into our next set of widgets, we can see some of these factors explicitly stated. Here we will see the duration, curve, convexity, and convexity curve factors, which are reflective of first or second order parallel and non-parallel movements in the yield curve. We can also see our risk-free and roll-down factors, which represent carry, with the risk-free contribution being the carry from the overnight risk-free rate based on the underlying currency of the asset, with the roll-down and the roll-down factor being representative of carry from the risk-free rate for longer periods than overnight, as well as including the impact of the passage of time on discount rates. Finally, we'll see our FX and FX carry contribution factors, where the FX factor represents the return attributable to the portfolio from the change in FX spot rates for non-base currency assets held in the portfolio, and the FX carry factor represents the return attributable to the portfolio based on the difference between spot and forward rates, specifically for FX forward contracts. Alongside this information, we can add key supplemental metrics like yield curve positioning, currency bets, and spread positioning. Other factors can be stated in the attribution model as well, such as spread-based factors and various curve basis factors for additional asset class coverage. After stripping out and explicitly stating the impact of these factors on performance, users are left with an excess return, which can be considered the piece of performance attributable to the investment decision process. The way in which we define excess is based on the investment management process of the portfolio. Decisions that are made at a portfolio level, such as yield curve and FX positioning, are excluded from the sector allocation and security selection calculations. Once we've determined how we'd like to define our excess, we can then perform a further decomposition of this excess return based on one of the various Brinson methodologies. The approach is really designed to answer the question of whether a portfolio's performance was due to sector allocation, implying over-allocation to good sectors or under-allocation to bad sectors, or security selection, which involves the portfolio outperforming the benchmark within a particular sector. Within this analysis, users have control over a variety of settings, including excess methodology. We're showing the core fixed income settings here, but various other options are available to the end user. Sector weighting, which controls how the allocation of a particular sector is measured, whether based on market value or some risk-weighted analytic like spread duration or duration times spread. Calculation method, which controls what type of attribution decomposition is used to calculate sector allocation and security selection. Each model is a specific variant of the Brinson framework. The relative to option controls how a good sector is determined, whether based on the return of its immediate parent sector or a benchmark total return. And finally, breakdown. Users can apply a variety of breakdowns to their performance attribution reporting, reflecting one or more layers of allocation decisions based on sector, country, currency, or many other types of decision points. The breakdown used in attribution reporting should be in line with the process by which investment decisions are made in the portfolio. This analysis can then be scaled to summary level reporting across multiple portfolios at once and enhanced via time series analysis launched from a right click within Explorer to provide daily transparency into performance and attribution results. The second key workflow a performance analyst might perform is fact sheet analysis, where we might want to look at a portfolio's track record over an extended period of time. With ex post analysis, we can examine a fund's performance over longer time periods, 1, 3, 5, or even up to 10 years or more, and understand how it's been managed relative to the benchmark. We can use statistical measures like tracking error, beta, information and Sharpe ratios, and more to understand how tightly the fund has tracked the index period over period. Adding in additional measures like upside-downside ratios and durations, as well as batting averages, can help us understand whether performance was due to sustained effects of consistent over or underperformance, or from smaller periods of larger deviation. Our last and final workflow to cover today is exporting data for use in downstream report construction. Once we've built out our views, we can save them down for later reuse as an entire workspace or a template, or generate a URL to share our workspace with colleagues. Finally, we can export everything to Excel or PDF for easy downstream use, as well as construct a batch report to enable scalable exporting of a variety of analyses across portfolios with a single click. In conclusion, we have covered workflows around performance information, attribution reporting, and ex post statistical information. Further information on Explore, the tool in which this demo was conducted, can be found in our user guide or in recorded sessions available on Aladdin client sites.